Welcome to Markets Now. I'm Michelle Rook along with Darin Newsom, a senior market analyst for Barchart. And we're seeing a lot of red on the board in grain and livestock futures trade this morning, Darin. And of course, let's get rid of the elephant in the room right away. It's report day. And obviously, you and I have talked before about, what USDA reports do or don't mean. But what is the market telling us right now about what we might see in the report?
The market's not telling us anything about what we might see in the report, and I like the way you asked that question. It's not telling us anything about what we might see. If we want to make some guesses, I think the key here is where we have to go back and look at what are the guaranteed prices from this insurance prices in the U.S. From this past spring. And it comes back to Uncle Sam doesn't like to write out big insurance checks. So if we're trying to make guesses about what could happen in this report, it wouldn't be surprising, particularly with corn, dollar under its guaranteed price, that somehow or some way we find, USDA finds a way to decrease expected or its production guess. So that's really the only thing that that's really the only guess that we can make going into this silly thing. As far as the market goes, what we've been seeing over the last couple of months is that the commercial side is growing more comfortable with 2023-24 supplies. We don't know anything about demand. We're making a few sales, but on the supply side, future spreads are certainly indicating in both corn and soybeans that commercials are getting more comfortable.
Well, and a lot of that has to do with this change that we have seen in the weather, right?
Mm-hmm. Absolutely. That's what it's all about. I mean, these are weather derivatives. And about midway through July, we saw the weather patterns change. Some are telling me, it was too late for corn, but looking at the market, the commercial side doesn't seem to think so. And in soybeans, we haven't moved to, we're still in a bullish situation as far as spreads go, but they're not as they're not as bullish as they were. And the reason why, we still don't have a lot of acres. We knew this past winter that we lost some acres between September and March. Corn did its job and bought acres away. So, it's not going to be completely like the Brazilian situation where they went from a good crop to a great crop, supposedly. But we're going to go from a questionable crop to a good crop here in the United States, at least by what we can tell with future spreads and the way they've been acting.
You can also tell that, though, in the basis levels, which have collapsed in some areas. And so, again, end users feel like, hey, I've got enough inventory at least to get to this new crop then, right?
That is correct. Not only in spread, not commercials don't always position themselves in spreads, but also in basis. And as you said, both old crop and new crop basis bids have been taking a bit of a beating here over the last number of weeks. Number one, it tells us that, as you said, we've got plenty of supply spot to finish off old crop, particularly with a slowdown in demand. And as we look ahead to new crop, there isn't a great deal of concern at this point about getting the supplies needed to cover what demand's on the books at this point. So, again, yes, you're right. Basis has been slowing down, both most notably in soybeans, but also in corn.
Okay. So demand is the other side of the equation. Once the market feels comfortable with supply, then we'll start focusing or transitioning into demand. So, price levels, how low do we need to go? Are we at levels where we are starting to stimulate demand or become more competitive on a global front?
As far the competitive on a global front is an interesting conversation, something we could spend an hour talking about, because I don't know that it really comes down to competitive price when we're talking about the world's largest buyer, particularly China. I think it has more to do with politics and the games that are being played elsewhere. So I think what it comes down to now is how long will Brazil's supplies of both soybeans and corn last into the next marketing year? And at what point does some of the world's largest buyers, again, including China, have to turn to the United States as a secondary supplier? And these are outside of, the values of the US dollar and the Brazilian real and Chinese yuan and all of these other things. These are some of the real world things that we have to deal with, outside factors other than value.
Yeah. So China is part of the equation, but also the Black Sea tensions rising. Will it eventually translate to any business for the U.S.? It hadn't here the last 18 months. So, do you see any corn or wheat business going over to the U.S. eventually?
There is a chance that eventually, and I like you use that word, eventually we could see some corn business. But, really of all the markets that stand out to me right now as we head into this next round of silliness is what's been going on in Chicago soft red winter. We've seen the September-December spread covering anywhere from 90 to 100% calculated full commercial carry, and in some cases, some days actually beyond that. And the CME is running its average right now for a full carry as it's getting set to possibly increase commercial storage rates based on this time frame through August 25th. And if that running average is greater than 80%, then we will see an increase in commercial storage rates as of September 19th. And as of Thursday's close, I think that average jumped up to almost 85%. And it just doesn't look like, I mean, it looks almost like a guarantee at this point that it's going to be greater than 80% on August 25th. So, we're looking at increased storage, and none of this is bullish. None of this is saying that demand is going to come pouring in, rushing in, and start to gather up these supplies in the U.S. It just continues to tell us the supply and demand situation for U.S. wheat is, particularly soft red winter wheat, is just incredibly bearish at this point.
Yeah. What are the technicals telling us?
Technically, market charts are a bit of a mess. If I look at the hard red winter long-term monthly chart for its cash index, it'll look like it had turned bullish here at the end of May, and all of a sudden here in August, we've taken out that low. So that raises some questions. Soft red winter, again, is mostly just chopping sideways in here. We're not getting a lot of selling, but any rally in the futures market's met by an increasingly bearish basis market. In corn, the key today, key Friday and into the weekend, is can it hold the July low of 481? I think that's kind of the key price.
Yeah. You and I have talked about that 481 level needing to hold before. Soybeans, we've kind of bounced off the 100-day moving average, 50% retracement, like around that 1290. So is that pretty critical there too, or not?
I think there could be some interest down at that level, but if we start to fall through it, the biggest thing in soybeans is our funds still holding a relatively large net long futures position. So if we start to crack some of these moving averages and we start to see some other types of pressure building in the market, would not surprise me if the funds start to get out of and just kind of throw in the towel on some of these long soybean positions.
Gotcha. Okay, let's talk about crude oil first of all, which has had a big run off of the lows here now, and we made some new highs for the year here this week. Mm-hmm. Do we keep going higher?
If we, from a purely technical point of view, it would suggest, hitting a new 4-month high this week would certainly suggest, yes, that, this market should continue to go up. Also, fundamentally, we talk about spreads all the time. We look at the forward curve in the crude oil market. It's been inverted, telling us the supply and demand is still tight, here domestically and globally. So, when both sides are bullish, that would tell us that, this market should be going higher. It struggles at times. It seems to run out of some buying interest. But as we were talking about, if traders are not going to get interested in the grain and oilseed sector, and if we start to see stock indexes sag a little bit after the big run they've had here through the early part of 2023, and they start to pull back a little bit this quarter, then I think some of the money is going to flow over to those market sectors where fundamentals are bullish, and that certainly is energies.
Yeah, no doubt. So the energy component, I started off with that because that's a big part of what we see in terms of inflation data. CPI out yesterday, PPI out this morning. What are those two indicators telling us about what the Fed might do going forward? Because it's been surprising to see that energy wasn't a bigger component or didn't push that number up higher.
Well, it's always interesting to listen to the economists argue about this, because for every 6 that say, these are still bullish economic numbers, there's 6 that are saying that, these are bearish numbers, they were bigger than expected, larger than expected, and so on and so forth. I think what it really boils down to is that what the Fed's been doing for a number of months, for a couple of years now, actually, and that's front running its next announcements, its next meetings, and its next announcements. A couple months ago, Fed Chairman Powell actually came out and said, look, we should be expecting at least one more, if not more, rate increase. Well, we got one in July, and the next meeting's in September. So I wouldn't be surprised if, for whatever reason, using the CPI, PPI, whatever numbers they want to be talking about, that the U.S. Federal Reserve raises rates once again, looking for another 25 basis point increase. So I don't think it changes. I don't think it changes the the program or the process that they're going through at this point at all.
You've got to think those inflation numbers are going to start creeping up, though, if crude oil and energy stay where they're at right now or go higher, right?
I would think so. Yes. If we see the type of rally that the charts are showing, then I do think that we probably close out 23 with some higher inflation numbers.
Yeah.
And that's certainly going to keep the Fed on the defensive, or I should say not on the defensive, but on the offensive when it comes to rate hikes. And what it most likely will do could push any thoughts of decreases. There was some talk that maybe we could start to see decreases by the end of the year, possibly into early 2024. I think that pushes those back a little bit if overall inflation reads start to go higher based on energies.
Yep, it puts them in the corner, that's for sure. All right, thanks for joining us, Darin Newsom, Senior Market Analyst for Barchart. That's Markets Now.